Okay, so welcome to the deep dive. Today we're diving into, I guess the major shifts, in global politics and economics as of today, April 7th, 2025. So this will be like your cheat sheet to really like quickly get up to speed on, what's truly significant, I think, in the world right now.
Yeah, that's right. We've waded through, a substantial amount of analysis of global political dynamics
Hmm.
and try to distill the essential insights. So, our mission here is just to, pinpoint what are the most important developments happening on the global stage, but more importantly, like what is their trajectory and where are they going?
And I think, what jumps out from all this information is three really dominant forces that are kind of interlinked. So, we're seeing a clear rise in protectionist policies. There's definitely a sharpening of, strategic rivalry, especially between the U.S. and China. And we're also seeing like a fundamental economic reordering that's taking place, worldwide.
Yeah, it's a really interesting time.
Okay, so let's maybe, unpack the first of these, U.S. protectionist trade policies. What's the headline there?
Well, I think the immediate point of interest is the potential for significant tariff hikes under, returning Trump administration.
Right.
And, the analysis suggests possible tariffs of 60% on goods from China and 20% on imports from, most other trading partners.
60% on China. I mean, that's a huge number. I mean, have we seen, tariffs at this level historically, and what kind of immediate impact could that have?
Yeah, I mean, 60% is, it's a really substantial number.
Yeah.
It would be reminiscent of the Smoot-Hawley tariffs of the 1930s, which many economists believe, really exacerbated the Great Depression. So the immediate impact would likely be a sharp increase in the cost of imported goods for U.S. consumers and businesses. And that could trigger, potentially a wave of inflation in sectors that rely heavily on Chinese inputs like electronics and consumer goods.
Yeah. So I mean, the core motivation here, as we understand it, is to bring manufacturing back home to the U.S. and to, lessen our reliance on countries considered adversarial,
Right.
right? It's about strengthening domestic industries and national security by not being so dependent on potentially, unstable foreign suppliers.
Right. The idea is to incentivize U.S. companies to either relocate production back to the United States or to source goods from domestic suppliers,
Yeah.
boosting American jobs and reducing vulnerability in, critical supply chains.
Makes sense, but what's the likely reaction, from other major players? I mean, it's hard to imagine the EU, China, and others just sort of standing by.
Yeah, the analysis strongly indicates that retaliation is highly probable. So, we can anticipate that the EU, China, and other nations affected by these tariffs are likely to respond with their own tariffs and trade barriers targeting U.S. exports. And that could lead to, significant disruptions across global supply chains, particularly in, sectors like automotive, electronics, and even energy.
Yeah.
Think about the complexity of building a modern car. Components come from all over the world.
Oh, yeah, absolutely.
And suddenly making those components, you know, significantly more expensive due to tariffs could really throw a wrench in the works.
Yeah, absolutely. The ripple effects could be, substantial.
Now, I've also, come across this term friendshoring. What exactly does that entail in this context?
So friendshoring is essentially the strategy of, redirecting supply chains away from nations considered to be geopolitical rivals or unreliable trading partners and towards countries that are viewed as politically aligned and stable.
The analysis specifically points to India and Vietnam as key countries that could benefit from this trend, potentially becoming more central hubs in global manufacturing networks as companies seek alternatives to China.
Interesting how some nations, could see significant upside in this shifting landscape. Okay, so let's turn our attention to, the escalating strategic competition between the US and China. It feels like, this has moved beyond just trade disputes.
Precisely. And what's particularly noteworthy is that there's now a bipartisan consensus within the U.S. on the need to, reduce reliance on China, at least in strategically important sectors.
So this isn't just a partisan issue. This is something that both sides of the aisle kind of agree on.
Exactly. There's broad agreement across the political spectrum on the importance of decoupling in areas that are critical to national security and long-term economic competitiveness.
Yeah, what specific sectors are we talking about here where this decoupling is the most intense?
Well, semiconductors and biotech are explicitly identified as, key areas of focus.
Yeah.
Semiconductors are the foundational technology for, virtually all modern electronics. And biotech is increasingly seen as vital for advancements in healthcare, agriculture, and even national defense.
I see.
So dependence on potential adversaries in these fields is viewed as, a significant risk.
Mm. Okay, and what tools, is the U.S. government employing to try and achieve this separation?
Well, the analysis highlights, the use of expanded export controls, which restrict the sale of advanced technologies and goods to China, particularly in the semiconductor space. And additionally, sanctions are being used against Chinese companies that are deemed to pose a national security risk or involved in, activities that are contrary to U.S. interests.
And how is China reacting to these pressures? I mean, they're, a major global player. They're not just going to accept this without a response.
Indeed, China has been actively developing its own countermeasures. These include the Unreliable Entity List, which allows China to penalize foreign companies that it deems to have harmed Chinese interests, and the implementation of more robust anti-sanctions laws.
Okay.
So the combined effect of these actions from both sides is what the analysis refers to as, economic bifurcation. It's effectively a splitting of the global economy into two increasingly distinct and separate spheres of influence.
So, imagine global technology standards diverging or multinational companies having to choose which market to prioritize, potentially leading to less efficiency and higher
Yeah,
costs.
exactly.
Wow. Okay. So we could be looking at a future with, less global integration and more parallel systems emerging. You also mentioned some battleground sectors in this competition. What are those?
So these are the sectors where both the U.S. and China are actively vying for, future dominance.
Yeah.
Green technology encompassing areas like electric vehicles, solar energy, and battery storage is a major one.
Yeah.
The country that leads in these technologies will likely have a significant advantage in the future economy. And then there are critical minerals like lithium and cobalt, which are essential for the production of batteries and many other green technologies. So control over the supply chains and processing of these resources is becoming, a crucial geopolitical and economic battleground.
Gotcha. Okay, so we're seeing, these significant power dynamics at play. Let's maybe look at the situation in the EU. Now, the analysis suggests a degree of economic fragility there. What's the main picture?
Well, the forecast for economic growth in the EU is relatively weak, projected to be in the range of just 0.8% to 1.6%,
Okay.
and several interconnected factors contribute to this energy. Insecurity remains a significant concern, especially given, the ongoing geopolitical tensions and Europe's reliance on external energy sources. Furthermore, the potential for new U.S. tariffs on key EU exports, like steel and liquefied natural gas or LNG, adds another layer of economic pressure.
And I recall reading about, Germany's debt break. How does that limit their ability to respond to these challenges?
So Germany's constitutional debt break places strict limits on the government's ability to borrow and engage in large-scale fiscal stimulus. And given that Germany is the EU's largest economy, this constraint makes it more difficult for the bloc as a whole to implement, aggressive measures to boost growth or respond effectively to external economic shocks, so they have less flexibility to use government spending to counteract a slowdown.
So less room to maneuver economically, and it sounds like achieving a united front within the EU on these issues is also proving to be a hurdle.
Exactly. The analysis highlights the challenge of achieving a cohesive and unified response within the EU to the trade policies of both the U.S. and China. Diverging economic interests and political priorities among the 27 member states often make it difficult to reach a consensus on how to address these external pressures.
All right, so some member states, might have stronger trade ties with China and be less inclined to support, confrontational policies.
Precisely.
It seems like these global shifts are also reflected in, a broader political trend, the rise of populist policies in various parts of the world.
Yes, the analysis indicates that the post-2024 election cycle has witnessed a notable increase in the number of populist governments in power, not only in the U.S. and parts of Europe, but also in several significant emerging markets.
And what are the common themes we see in the agendas of these populist governments? What are their shared priorities?
Well, several key themes emerge. A strong emphasis on protectionism, often manifested in, the implementation of trade barriers and tariffs, is common. We also see a focus on stricter immigration controls and a tendency to either slow down or roll back existing climate change policies. These governments often prioritize, national interests and are more skeptical of multilateral agreements and international cooperation.
So this could have significant consequences for the future of global trade and efforts to, address climate change on a global scale.
Precisely. The rise of these populist governments could pose a significant challenge to the stability and effectiveness of multilateral trade agreements, which rely on, international cooperation and compromise. It also introduces uncertainty regarding the future of green investment incentives and commitments to emissions reduction, as some of these governments may prioritize short-term economic gains or national sovereignty over climate action.
Okay, let's maybe now delve into some more specific areas that are becoming strategically important, like biotech and digital sovereignty. It sounds like nations are increasingly viewing these through a national security lens.
That's absolutely correct.
Yeah.
Countries are increasingly recognizing that advancements in biotechnology have, profound implications for public health, national security, and economic competitiveness.
Right. It's no longer viewed purely as a, scientific endeavor.
Exactly.
So what's the practical outcome of this shift in perspective?
Well, the analysis suggests that this is leading to a fragmentation of research and development ecosystems and supply chains within the biotech sector. So nations are prioritizing the development of domestic capabilities and may be restricting collaboration or access to technologies for entities from countries they consider strategic rivals.
I see.
So this could slow down the pace of global innovation in this critical field.
And then there's this concept of digital sovereignty that keeps coming up. What does that really mean?
So digital sovereignty essentially refers to a nation's ability to have control over its own digital infrastructure, the data generated within its borders, and the technologies that underpin its digital economy.
Okay.
And this is manifesting in the form of digital sovereignty laws, which aim to regulate data governance, cross-border data flows, and investments in the technology sector. These laws can have significant implications for how tech companies operate internationally and where they choose to invest and store data.
Okay, so we've outlined, these major shifts in the global landscape now for our listener who's, trying to make sense of all this from an investment perspective. What are the key implications across different asset classes? Let's start with equities. What sectors are looking overweight according to this analysis, and crucially, why?
Right. So the equity space, the analysis suggests focusing on U.S. defensive sectors, such as utilities and healthcare.
Okay.
The rationale here is twofold. Firstly, these sectors tend to be more resilient during economic downturns, providing a degree of stability. And secondly, reshoring initiatives could indirectly benefit domestic infrastructure and healthcare services. Additionally, biotech and AI companies that are well positioned to navigate the evolving regulatory landscapes in the U.S. and EU are seen as potentially attractive. Finally, companies involved in enhancing supply chain resilience, such as manufacturers in Mexico and providers of IT services in India, could gain as global firms diversify their sourcing. So the theme here is investing in sectors and regions that are either insulated from the immediate trade tensions or directly benefiting from the shifts.
Makes sense. And conversely, what areas are suggested as underweight? What are the red flags?
Yeah, so the analysis points to being more cautious on Chinese exporters that are heavily reliant on the U.S. market, particularly those in sectors facing high potential tariffs like electric vehicles and solar panels, European industrial companies that are vulnerable to increased energy costs, and the risk of retaliatory tariffs from the U.S. or China are also flagged as potentially underperforming. So the underlying concern is exposure to the direct negative consequences of protectionist measures and geopolitical tensions.
Okay, moving on to the commodities market. What's the outlook there given all these dynamics?
Right. So in the energy sector, the analysis anticipates short-term price volatility in LNG and oil markets, largely driven by ongoing geopolitical instability in regions like the Middle East and Ukraine. So
Right.
this could present opportunities for short-term trading strategies. Right. However, the longer-term view suggests potential in U.S. renewable energy projects supported by the incentives provided in the Inflation Reduction Act. The U.S. legislation aimed at boosting clean energy and reducing inflation regarding critical minerals like lithium and cobalt. The focus is on direct investment opportunities in countries like Australia and Canada as a strategy to reduce reliance on supply chains that are currently dominated by China. So the key here is resource security and diversification.
What about currencies? Are there any notable trends or predictions in the foreign exchange markets based on this analysis?
So the U.S. dollar is expected to maintain a degree of structural strength, primarily due to its status as a safe haven currency during periods of global uncertainty. However, the analysis advises monitoring the potential for competitive devaluation as countries grapple with trade imbalances. The Australian and Canadian dollars are viewed as potentially benefiting from their countries' roles as key exporters of critical minerals to the growing technology and green energy sectors. Conversely, the outlook for the euro is somewhat bearish, reflecting the growth challenges and tariff risks facing the European Union. So essentially, slower economic growth and increased trade barriers tend to weaken a currency.
Right. Okay. And in the realm of fixed income, what's the suggested approach for bonds?
So for sovereign debt, the analysis recommends focusing on traditional safe haven assets like U.S. Treasuries and German bonds as a way to mitigate broader market risks. Caution is advised on most emerging market debt, with the exceptions of India and Vietnam, due to potential vulnerabilities stemming from commodity price fluctuations and geopolitical instability in the corporate bond market. The focus should be on North American issuers in relatively stable sectors like utilities and healthcare, which tend to have more predictable cash flows even in uncertain economic times. So the emphasis is on safety and stability.
What about alternative investments? Are there any areas that stand out in the current environment?
Yeah, so within alternative assets, real estate linked to data centers is highlighted, driven by the increasing importance of digital sovereignty and the growing need for secure and localized data infrastructure. North American infrastructure projects could also benefit from the trend of reshoring and the need to upgrade domestic infrastructure. Finally, gold is suggested as a potential hedge against both geopolitical shocks and potential volatility in the U.S. dollar. It tends to perform well when there's uncertainty in the global economy.
Finally, if our listeners thinking about their overall geographic allocation of investments, what's a high-level strategy suggested by this analysis?
Okay, so the analysis proposes the largest allocation, perhaps around 40% to North America, capitalizing on reshoring, technological innovation, and the ongoing energy transition. Asia Pacific, excluding China, is recommended for a significant allocation, maybe around 30%, with a focus on India as a manufacturing alternative, the ASEAN region as a growing center for technology, and Japan as a beneficiary of a weaker yen in export markets. A smaller allocation to Europe, perhaps around 20%, is suggested, with selective opportunities in German industrial companies that could adapt to the new trade realities, and Nordic countries leading in renewable energy. Finally, a smaller allocation, around 10%, is recommended for Latin America, and the Middle East, focusing on commodity exporters like agricultural producers in Brazil and energy companies in the Gulf states that could benefit from supply chain diversification. So this overall strategy emphasizes regions that are either driving the economic order or are less exposed to its immediate risks.
So to bring it all together for you, our listener, the key message seems to be one of adaptability and careful selection. The analysis suggests prioritizing sectors and regions that are more resilient to the trade tensions and benefiting from the emerging trends in the near term. That points towards U.S. defensive stocks, the critical minerals supply chain outside of China, and U.S. dollar-denominated assets. And while there's certainly uncertainty, there are also compelling long-term opportunities in areas like biotech innovation, the build-out of digital infrastructure, and the ongoing shift towards sustainable energy.
Exactly. It's about understanding these fundamental shifts in the global landscape and positioning your investments to navigate them effectively.
Well, this deep dive has certainly provided a valuable snapshot of the, significant global political and economic changes we're seeing right now. It's clear that these interconnected trends will continue to shape our world in, profound ways.
Yeah, what's really striking is the interconnectedness of these forces. How trade policies influence technological competition and how political shifts can reshape economic strategies.
Yeah.
It's a dynamic and evolving picture.
Yeah, and on that thought, here's something for you to ponder. Considering these significant global shifts we've discussed, what previously unquestioned assumptions about international trade and investment might now warrant a serious reevaluation in your own thinking. It really prompts you to consider how these unfolding dynamics might reshape the future and what new possibilities and challenges could lie ahead. We'll continue to explore these evolving trends with you in future deep dives.
Yeah, it'll be interesting to see where things go.
Absolutely. All right, thanks for joining us.
Thanks for having me.
See ya.